Hey guys, if you haven't heard, Paramount and Skydance merged into one company called PSKY. It poses a unique opportunity to buy the stock. Right now, PSKY has purchased the exclusive rights for $7.7 billion to all UFC events, which will air exclusively on Paramount networks in the United States over the next 7 years. Dana White was quoted in an interview saying he believes the management at Paramount will make more aggressive moves over the next 7 years to come. David Ellison is the CEO of the company. He's the son of Larry Ellison. For fun fact, he's the owner of, or one of the owners of Oracle, whose net worth is estimated to be over 300 billion. He still to today holds shares in his son's company. David's passionately into film and has had a successful career in the industry. Even fast forwarding to today, in David's first week as the CEO of Paramount, he signed deals with South Park at 1.5 billion over 5 years and the UFC at 7.7 billion for 7 years. The whole enterprise value of the company, equity, debt, less cash, right now is 30.7 billion. Institutional and insiders own 82% of the stock. It's the fastest growing sport to watch. There's been decline in viewership across football and basketball, as you can kind of see in the graph over here. MMA is the only 30-year-old sport, and it's just entering its high growth period as compared to some of these other sports like basketball at 75, NFL at 100, and the MLB all the way at 150 into a decline, and the NBA being still in the growth stage here. It's ahead of boxing, which I thought's over here. You can just look at a cool Google Trends chart for UFC and boxing over time. UFC is the blue line, boxing is the red line, and see the outpace, which is pretty impressive given how the UFC only recently started. Here's a picture of just Dana White, who runs the whole UFC show. Um, they don't even have a true number, which is interesting because everyone always illegally streams UFC. It's still on this prehistoric pay-per-view template where you have to pay $50 to watch 12 fights a year and maybe four other fights are free. But a lot of fans have been priced out of pay-per-view events. So here's a cool graphic I found with comparing the UFC versus the WWE. The UFC revenue is greater than the WWE's revenue in 2024, although it's very close at 1.4 billion versus 1.39 billion rounded. It'd be very close, but either way, the UFC is starting to edge out the WWE, and I think that's just interesting because the WWE, I believe, began in the 70s, and the UFC got its first debut in the late 90s, so nearly 30-year difference in span, but yet you can see the revenues from the two businesses are almost equal. And what's even more interesting about that to me is that you can see the size relative to the sport, even though it's been around a lot longer, like I mentioned before. But then you think that the UFC is on pay-per-view events, and each event, like I brought up before, is $50 or so. A lot of people are priced out or only pick a couple of events to watch a year. And there's a lot of illegal streaming also. So making it available to everybody, I believe, is going to bolster views and revenues. Here's another cool chart just showing the exponential growth in UFC fighters from a few dozen to half a thousand UFC fights a year. The number of fights have grown exponentially from the mid 2000s. I'm not going to spend too much time on these next two pictures, but just showing that the NBA viewership has been on a steady decline and through the regular season as well as the finals in the chart below. And here's the next picture of the NFL viewership for the Super Bowl specifically being down consistently year over year. And I just thought it was interesting because David Allison is the founder and the CEO. The owner and founder led companies outperform the rest of the companies historically. You can see this graph below, provided from a Harvard Business Review study. You can find it online from a quick Google search. Give it a read, it's really interesting. Here's the income statement for PSKY. You can see revenue was consistently growing until 2022. Revenue saw a slight decrease in 2023 and 2024, but in my opinion, I think they're poised for larger growth in 2026 and 2027 due to the UFC and South Park rights, as well as management preparing for more aggressive moves to come, like Dana White had said. Free cash flow here, this is the cash flow statement, has been decreasing significantly since 2020, but it has been on the increase for 3 straight years now, from a negative half a percentage to 1.8% now. So just running it through real quick, DCF, some of my summary inputs here. I put the actual for 2024, 29 billion in revenue, free cash flow of 1.8%, about 507 million. Grown revenue at the analyst consensus at 2% for 2025 here brings us to just about 30 billion. And with their recent acquisition of the UFC, South Park, and much more aggressive purchases coming, in my opinion, over the next couple of years, I think they'll be able to hit 32 billion by 2026, and keeping it conservative from 3% there out in the terminal year. It takes it all the way to 36 billion. Throughout those years, I have varying levels of free cash flow. As you can remember from the last slide, the company's free cash flow has, seen significant decreases, although I think they can bring it up in the future. We're just gonna, tame our expectations here and be more conservative. And looking at the free cash flow, we have 1.8%, just about 2% rounded. Um, if we're just showing one decimal point. And it goes down to 1% over the next 2 years with the analyst consensus. But I think they can bring it back up to, the 2% mark and eventually 3. And being ultra conservative at 5%, competitors are well above that. But just being with their conservative estimates, this is where I put it for now. Um, if you don't know what a mid-year convention is, you can Google that, but it's basically one divided by one plus the interest rate raised to half a period, because you're making an assumption that a business collects its cash evenly throughout a year, which would be halfway. Because if you want to do a present value, you can either do present value from the beginning or from the end. But if you take it from the beginning or from the end, you can overflate, underinflate. So if you assume it from the middle, it's usually the most fair valuation metric. And obviously, with the time value of money, if you don't know about that, you can Google that too. It probably isn't the best place to discuss that. We can do that another time. But we assumed a discount rate of 9% for the company, and going over time, we can see that it yields some of the free cash flows of 23 billion. They have about 8.3 billion in cash and almost 17 billion in debt for an enterprise value of 31.6 billion. And that's done that way because if you're going to buy the company, you're going to pay for all the cash flows, 23 billion. You're gonna have to acquire the debt that the company has issued to keep the company running. So you would add the debt, and then any cash would be used, to efficiently pay down, or just keep in the operation. So usually subtract that to get to an enterprise value of 31.6 billion. And there's about 1 billion shares. So we are projecting here a target share price of 28.99, just about $29, with a current price of 16.11, with a margin of safety or upside here of 80%, which in my opinion is pretty comfortable. So here's just a quick comparable company analysis with our company, PSKY, Netflix, Warner Brothers, Fox, Disney, and then some other you probably haven't heard of, but they are local, more local news, and some UK company owned rights, and you can look into it, but it's Nexstar and IPG. So basically, I'm just looking at a couple ratios here. This is historically looking EV to EBITDA, EV to revenue, market cap to levered free cash flows, and price to sales are the historically looking. Forward looking, we have the price to earnings, the market cap to free cash flow, their forward free cash flow yield. Then just for some random statistics I like to include and look at are the revenue growth over the last 5 years, their last 12 months free cash flow margin, the last 12 months revenue, and then just their enterprise value and size. So you can see that P-Sky is 31 billion, 30.7 billion here in enterprise value, which puts them in the lower half of the list here, right? The median being at 43. I'm just looking at some other statistics. You can see the highlighted boxes as the PSKY as our company and the subject company, and the median, which is what I'm comparing it to. I didn't want to use the average because Netflix is kind of an outlier, and sometimes Disney in certain scenarios is been an outlier as well, but just looking at certain scenarios, you can try to price it off of EV to EBITDA, EV to revenue, and basically looking at it and then you cut it certain ways, and you can see about 50% of the time these ratios show that they're undervalued compared to the peers, which usually it's hard to even find 10 or 20%. If you look at the EV to revenue multiple that I'm using, because I want to account for they have a lot of debt. So if you just look at the market cap, you're not going to get the full picture. Like for example, here's a good example. If you look at the price to sales uses the market cap and doesn't use the enterprise value. Enterprise value would be the market cap plus the debt less cash. And since it doesn't, it makes it look even cheaper at 0.61 times, but a more realistic approach here would be the EV to revenue number I pulled, which would be 1.07. So looking off of EV to revenue, which I feel like is a good solid metric to look at, they trade at the lowest amount. We don't know exactly where their earnings are going to go, where their margins are going to go, but I feel like we have a grip on revenue being consistent at this size and with their programs and with the addition of their programs in the UFC events and the further expansion on the more aggressive buying that Dana White alluded to in his interview. I think that there's more upside on the revenue, and pricing it on a revenue multiple instead of the earnings multiple kind of make it simpler for us. So even looking at the group, you can look at the second column here, the EV to revenue. PSKY is 1.07 with every other company being significantly above that. Even going with the absolute conservative of IPG, 1.43 times revenue. You can see flowing through my model would be, with our sales of 28.7 billion, which is before everything. You'll see before the UFC editions and these other editions, we get an implied valuation of 41 billion. There's 15 billion, 15.5 billion in debt and 2.7 billion in cash for an enterprise value of 53 billion. There's about a billion shares, which implies a price of about $49.49. And the price right now is $16.11, which shows significant upside just pricing it based on an EV to revenue multiple.